Sometimes the market is like a game of chess, where most people only see the last move made, whilst the real battle is taking place several moves ahead. With experience, you begin to realize that the price on the chart is merely the result of decisions made by thousands of participants, rather than a random collection of candlesticks and price movements. My analysis used to be rather superficial. I would look for levels, follow the trend, and try to find convenient entry points. But gradually, I came to realize that identical patterns can produce completely different results depending on what is happening within the market. It was then that I began to look deeper, not just at price movements, but also at the behavior of market participants. One of the most telling examples was in the oil market. After several weeks of growth, the price approached a zone of strong resistance where large sell-offs had previously been recorded. Most expected the momentum to continue against a backdrop of positive news and reduced supply. But I noticed the behavior of trading volumes. Despite new local highs being set, buyer activity began to decline. The market seemed to be moving upwards purely by inertia. A particularly significant signal was how the price reacted to attempts to break the previous high. Each new upward move was weaker than the last, whilst the pullbacks became deeper. This often suggests that a major buyer is gradually exiting their position, using the crowd's heightened interest as liquidity. After a false breakout occurred, I opened a short position with a small risk. A few hours later, oil began a rapid decline, and the market returned to the range. A similar situation occurred on the EUR/USD currency pair following the release of Eurozone inflation data. The initial reaction was very sharp. The price surged, breaking through the nearest resistance. But instead of continuing its movement, the market began to stuck near that level. I noticed that after the news, buyers were unable to maintain momentum, and large volumes began to trade precisely in the area of the highest prices. This looked like position distribution rather than the start of a new trend. In such situations, it is particularly important not to react to the market's initial emotion. Most participants see only a strong candle and try to jump on the move as quickly as possible, but experience shows that the best trades often appear only after the first wave of emotion has subsided. In such situations, it is particularly important not to react to the market's initial reaction. Most traders see only a strong candlestick and try to jump on the bandwagon as quickly as possible. But experience shows that the best trades often emerge only after the initial wave of emotion has subsided. In the equity market, I increasingly analyze not only individual companies, but also their performance relative to the sector and indices. Sometimes a stock begins to look stronger than the market even before positive news emerges. This may indicate hidden demand from major players. On one occasion, it was precisely this relative strength that helped me spot a turnaround in the industrial sector in advance, when most investors were still bearish. The deeper you delve into analysis, the more you realize that the market rarely moves by chance. Behind most strong movements lies a battle for liquidity, crowd psychology, and the interests of major players. And perhaps the main takeaway from this stage is that a good trader learns over time to look not only at the chart itself, but also at the reasons behind price movements. It is this understanding that gradually transforms a set of signals into a complete picture of the market.